Good morning. Thank you for joining us for an inspiring conversation about sustainable finance. My name is Janet Goodfellow, and I'm your moderator this morning. I am a recent Laurier grad, and I come to this conversation with many years of engineering project experience in renewable energy and water and wastewater treatment projects, and many years of experience helping clients manage multidisciplinary environmental compliance challenges. And I'm really excited to be moderating this panel today. Glad that you folks could be joining us. But as we begin, I'd like to take a moment to acknowledge that Wilfrid Laurier University's campuses are located on the traditional territory of the Anishinaabe, Haudenosaunee, and Neutral peoples. Perhaps you're joining us from another location, and in that case, I would encourage you to take a moment to honor the Indigenous peoples who have lived and worked where you reside historically and presently. Acknowledging them reminds us of our important connection to this land where we live, learn, and work. We recognize, honor, and respect these nations as the traditional stewards of the land and water. Now, I'd like to introduce you to our speakers today, Madhu, Kalimipalli, and Aadhaar Verma. Madhu and Aadhaar, do you want to come on screen? Just give Madhu a second here. All right. Great. Very pleased to introduce these two gentlemen. Madhu Kalimipalli is a professor of finance at Wilfrid Laurier University's Lazaridis School of Business and Economics. His research focuses on fixed incomes, financial intermediation, international finance, corporate finance, and financial markets. Madhu is an affiliated member of the Waterloo Research Institute in Insurance, Securities, and Quantitative Finance, and Laurier's MS2 Discovery Institute, as well as a senior fellow at the International Center for Economic Analysis and the Canadian Sustainable Finance Network. His industry experience includes various assignments in risk assessment at Bank United and Duke Energy as a quantitative analyst with the Fixed Income Research and Development Group at Bloomberg, New York. So pleased to have you with us today, Madhu. And then Aadhaar Verma is an assistant professor of finance at Laurier's Lazaridis School of Business and Economics. His broad research focus lies at the intersection of finance and accounting, where he uses empirical archival methods to examine research questions in the areas of mutual funds, accounting disclosure, and sustainable finance. Prior to his academic career, Aadhaar worked as a credit analyst and software engineer in India. So welcome, Aadhaar, and thank you again for both of you for sharing your time with us this morning. We're really looking forward to the conversation. So I think I'm going to kick things off, but in a few moments, we're all going to share our insights and research into sustainable finance, and then we're going to open up our conversation to the audience. So as we are talking here today, please feel free to pop your questions into the Q&A box as we go. Don't need to wait to the end, and as soon as we wrap up the presentations, we're going to start working through some questions, and we're hoping to leave a healthy amount of time for that discussion. Looking forward to it. So to begin the conversation, I am going to do a bit of an overview here on sustainable finance to kick things off. Share my screen. There we go. So, I wanted to kind of give a quick overview here of some of the concepts that we're going to be talking about in more detail, Aadhaar and Madhu. So I wanted to talk initially about what is sustainable finance? What are we talking about? What are we referring to? And it's really a way of aligning financial objectives with sustainable long-term value creation within organizations. It's a shift away from focusing on short-term share price movements, and by integrating environmental, social, and governance considerations into that financial decision making, we extend the horizon of the evaluation we do for sustainable investments. And it's really helping move the needle as we are trying to address global challenges such as climate change, resource depletion, inequality, and corporate accountability. And over on the right hand here, we've tried to kind of capture the number of different ways that this sustainable finance is discussed in investment circles. There are a lot of different ways that sustainable finance is interpreted. And so you may hear any or all of these terms used when people are discussing sustainable finance. I wanted to give you an example, though, of how sustainable finance is really having a material impact. And I chose climate change, although there are many different options I could have chosen here. I think we are all getting more and more familiar with the graphs that I'm showing here. But I think this one is interesting because it helps us understand that while there have been agreements made, for example, in 2015, the Paris Agreement, there are still ways to go in terms of the gap between our policies, pledges, and targets, and how we're going to achieve that agreement. And this is really where sustainable finance are going to be necessary to fill that gap, trying to hit that target gap and that implementation gap, and fund the projects that are going to be required. My background is engineering, so as an engineer, I really feel this keenly, where there does need to be investment made into these gaps so that we are able to close them and successfully address some of the climate change challenges. I would be remiss if we didn't talk about ESG. We're going to be using this acronym quite a bit as we go through the slides today. So I wanted to cover just fundamentally what are the definitions for ESG and give some examples. So ESG stands for environmental, social, and governance. Environmental are the organization's impacts on the natural environment. They include the things like climate change, waste, pollution, water, deforestation. Social impacts are those that an organization's activity has on society. And so these could be internal stakeholders or external stakeholders. Internal would be things like employee engagement, how an organization interacts and engages its employees. But external might be things like in our local community, are we paying equitable wages to our employees, or more broadly at the global level, things like modern slavery, child labor, working conditions, and et cetera. And then on the governance side, this is more internally focused, thinking about how an organization is structured such that shareholders have a value and have voice in the decision making. The organization needs to be accountable to shareholders, but how is that actually happening in practice? And that's kind of encapsulated within that governance pillar. And then how does this ESG data connect to investment decisions? Aadhaar is going to go through this in quite a bit more detail. So on my discussion here is just going to be at a high level. But I think it's really important and interesting to note the evolution that I personally have seen through my career. As I said, I've been doing this for over 20 years. And I think if you had said to me 10 years ago that the investment community was going to be driving a lot of decisions around corporate data and reporting for environmental, social, and governance, I'm not sure I would have believed you. But really, there's this quite a direct connection now where corporates are reporting their environmental, social, and governance data either through voluntary or mandatory now in the EU through these organizations, and the investors are using that data and to make investment decisions. So there's much more of a direct connection between the activities within a corporation and the data that they are reporting and the decision making that's happening in the investment community. And I think that's been a major and important shift as we have evolved through kind of some recent discussions around climate change and et cetera. So with that, I'm going to stop sharing and hand things over to Aadhaar, and he's going to pick it up and continue on.
Thank you, Janet. Let me just take over and just share my slides with you all. Okay, hopefully it's all visible. So I'd like to begin the conversation about ESG and sustainable finance by beginning to talk about like where Janet actually introduced how ESG is, and that is on aligning financial objectives with sustainable long-term value creation. And a question that would come up is, well, why can't I just simply, or why can't we as investors just use a financial objective to actually create that long-term value? What is wrong in our current financial objectives system that prevents us from doing so. And it is helpful to actually then talk about like how this financial objective criteria actually came about. And it came about by a very famous article that was written by an economist called Milton Friedman back in 1970 in the New York Times. And he said that the only responsibility of a business, as long as it is playing by the rules of the game, by the rules of the society, is to increase its profits. To be clear, Milton Friedman was not denying that the firm managers do not have a moral compass or should not exercise their moral compass. But what he argued in his article is that since a firm manager is hired for the express purposes of actually managing a business, the manager should not actually use any of the firm's resources for any ends apart from actually maximizing the value of the firm. And he made this argument in the context of a charity. So suppose that like we have a firm manager or a CEO who wants to help reduce homelessness or child poverty. Well, if this manager is now devoting some of his time or some of the firm's resources in terms of money, that money is not the manager's money, it is the firm's money. And that money is coming from someplace. It could either come from the profits of the business, in which case then it is kind of like the manager is taking the money away from the shareholders and giving it away to charity. Or the manager could actually increase the price of the product that the firm is selling, thereby asking the customers of that business to actually bear a cost so that they can actually help the charitable contributions that the CEO favors. Or the CEO or the manager could actually suppress the wages of his own employees, of the employees of the organization, paying them a wage that is lower than the market wage, and use the savings that he has actually generated by paying his employees a smaller wage and then giving that money away to charity. And he said that that's not right. The only reason why a manager is hired, why a CEO is hired, is to manage a business. What gives the manager a right to actually do this? As long as the shareholders wants to engage in charity or the customers want to donate to charity, sure, they can donate it in their own private spheres. They can actually go to their local charities and donate that money. It is not the responsibility of a firm to do so. And he made this argument also in the context that, well, if a person is responsible for two things, if a person is responsible not just for a firm, but also for the charitable proclivities of the manager, then the manager can just do a thing of like double dealing. They can say, well, I was trying to help the firm. I was not, or I was trying to actually help the charity. And that's why my firm performance suffered. So that was Milton Friedman's argument that as long as firms are playing by the rules of the game, by playing by the laws that the society have actually decided on, then it doesn't matter how they make their profits. The and for a while, this argument actually, lasted quite a bit, and it was accepted quite prominently by a lot of people within the business and the political community. But people realized that there were flaws with this argument. And it is the main argument comes that, well, products and services cannot just be good, they can also be bads. They can be products that are problematic in nature, that do not actually benefit, that actually may have benefits for the user, but may actually have drawbacks or may cause the society harm. And we see this mostly on products such as gambling, firearm, and tobacco products. We know that smoking tobacco in public spaces by passive smoking causes harm to all those people in our vicinities. And so it stands to reason that, well, that maybe we do not actually want to actually have these bad products and they need to be somehow regulated or discouraged in any case. But the argument goes that since we live in a free society and since we respect personal freedoms, since we respect the choice of adults to make their own decisions, it does not matter. Okay, if a person does want to actually consume tobacco products or use them, then that's their personal choice. And I, as an individual, should not actually allow, you know, make the person have subject my own beliefs onto any other person. It is a personal choice and I should respect it. Now, is this the most efficient argument though? So let me take two examples on where this argument starts to fall apart. So around 2008, 2009 in the United States, we saw a large scale of mass and public shootings. And some of these tragically happened in elementary schools where children lost their lives. And as a result, the business community, the entrepreneurs in the US came with bulletproof backpack for children. Now, and this has now actually become a school staple for school children in some parts of the United States. That when at the start of the school year, the parents will actually go out and they will buy bulletproof backpacks for their children. Now, this kind of beggars belief. Like, is this the right thing to do? That like we allow so much freedom to exist that like we make society, you know, unsafe for children, while to prevent this, the dangers that are posed to children in schools, we actually have to create an entire new product such as bulletproof backpacks. Is this the most efficient use of a societal resources? People may actually argue no, that the proper thing would be to actually prohibit or at least curb the use or reduce the use of firearms in public spaces so that children can be safe. Here is another example, but in the context of the environment. So in southern Nigeria, where there's a lot of oil to be found, two companies, British Petroleum and Royal Dutch Shell, have a lot of pipelines that actually transport oil out from the ground and then they ship it by tankers for further processing in parts of Europe. Now, these pipelines have been shown to be notoriously leaking, and that is what this person on this image is showing you here, that the entire farmland is now polluted. According to Milton Friedman's argument, well, this is a problem that the Nigerian government should be solving by better regulation. And as long as the firm is playing by the regulations that the Nigerian economy or the Nigerian state has it, then it is fine that the pollution is happening. And if the shareholders or the firm owners of Royal Dutch Shell so choose, they can use the profits of Royal Dutch Shell to actually do a cleanup operation in southern Nigeria. But again, it asks the question, well, is this the most efficient way to actually use the money? Wouldn't it be better to actually not have the pollution to begin with? Why first create a problem and then solve the problem? Okay, it would be better to not have the problem to begin with. And in economics, we have a special term for this. We call this negative externalities. That any product that is actually harming someone else, but not the user of the product, should be curbed or should at least its usage should be minimized. And the classic case of this, of course, is tobacco smoke. We do not allow smoking in public spaces. And that is a case of like we are curbing the negative externality that passive smoking causes to people who are in the vicinity of secondhand smoke. So this is the first flaw in the argument of short-term value creation. But there's an even bigger, deeper flaw. And that deeper flaw comes from the phrase that, again, Friedman has used, which is playing by the rules of the game. Who decides these rules of the game? In an ideal society, the rules of the games are decided by the citizens of that country. The citizens of the country elect legislators. These legislators then take the view of listen to their population, they listen to the people, and then they follow and then they create laws, and then those laws are then enforced. Now, that is in an ideal democracy, that is there in an ideal state. We need to ask the question, are we in an ideal democracy? In other words, is Canada an ideal democracy? And I would argue that while we are quite good in our democratic principles, we are not ideal by any state of the means, any state of the definition. So on the right over here, you have the lobbyist of the month, and this is from an environmental agency that shows that Canadian Gas Association had 15 meetings in November 2023 with high-ranking public servants, and they were talking with the Natural Resource Department of Canada, and they were asking for subsidies for the oil gas pipelines. In other words, they are influencing the lawmakers to make laws that actually benefit them. So they're not, so corporations are not playing by the rules of the game. They are making the rules of the game. They're not just rule takers, they are rule makers. And we know that, well, if you have rule makers and rule takers, then the game is not fair. Then that they will actually use the rules for their own benefits. And that is why you actually see these bizarre statements by politicians who actually deny the role of climate change, or who take things like, who take scientific evidence and then just twist it and just completely refute it. So, for example, there's a politician who is right now claiming, I'll not name the politician, who is saying that he regretted getting the vaccine for the coronavirus. He's just refuting the science because he's playing to the gallery over here. And so here we see, like, this entire thing, while, the argument that Milton Friedman had made of like actually saying that like maximizing firm value will create long-term value for the society as well, it may not hold true in real life. And people realize this very early on. This actually started in the 1970s and the 1980s at the height of the Vietnam War. And then when the use of tobacco products began to be medically accepted as harmful, they were religiously minded investment funds such as Domini Investments and Calvert, who made a conscious choice that they would not invest in those products or those services that are harmful. This is called negative screening. So you screen out all the products from the economy that are negative, and you say that we will not invest in them. And was termed as the social responsibility investment movement, or the SRI movement. And while it was quite popular, it remained a niche investment strategy. It did not actually expand to the overall economy, to the overall investment community. So in the 2000s, the United Nations, under the guidance of the then United States Secretary General Kofi Annan, launched something called the United Nations Environment Program, or the UNEP. And by 2006, they formed this thing called the Principles for Responsible Investment, the PRI. And they were able to convince major institutional investors such as CalPERS and the Norwegian Government Pension Fund. These two pension funds, by the way, have more than $1 trillion in assets under management. They said that, would you be willing to actually not just actually exclude harmful firms, but actually start engaging with firms and persuading firm managers to do the right things? And this thing then eventually morphed into what we call the ESG landscape, or the environmental, social, and governance landscape. And the idea behind the entire thing is that you want to reward firms that are doing good by giving them money, by investing in them, and that therein then reduces their cost of capital, and that allows them to do even better projects. That allows them to actually do good. And the entire mantra of this exercise was that you want your money not just to earn you money, but you also want your money to do good things. And by the year 2020, there were more than 3,038 signatories in over 100 countries, and there were more than $100 trillion mapped onto ESG investments. So far, so good. But then we have problems that started to emerge. Unlike firm profitability, which can be measured in dollars, ESG is a fuzzy concept. It is an amalgamation of three things: the environmental score, the social score, and the governance scores. And it you want to then see, well, how are these scores being measured? And over the time, these scores have become more and more complicated. When the KLD, the Domini investment, started in the 1980s, they were collecting a total of 8 items. And with these 8 scores, they were able to compute the ESG score. By 2020, this had become 78 different scores. And then they were being amalgamated into a single ESG score. When researchers started looking into other ESG rating firms such as Refinitiv and Sustainalytics, they found that the number of items that they were actually rating firms on were in the hundreds. So for example, Refinitiv has more than 282 items on which it rates a firm. And because there is so much like disagreement, because like people are unable to understand, like unable to come up to a proper conclusion of what ESG really means, on what metrics to actually reward firms or punish firms, this leads to what in the research literature is called ESG confusion or ESG disagreement. So this is an graph from a 2022 research paper that talked about the disagreement between different ESG firms for the same company. So I'd like you to focus on this firm over here, which is Altria. So let me just take a laser pointer, Altria Group. And Altria Group is the holding company of Marlboro cigarettes. And over here, you'll see that Altria Group has a negative ESG score if you actually use the ESG score from MSCI, but it has a positive ESG score if you actually consider the ESG score from Robeco-Sam. So now as an investor, I'm confused. Well, are Marlboro cigarettes is the owner of Marlboro cigarettes, Altria Group, a good ESG firm or a bad one? And if I am just wanting to invest uh, to maximize my returns, I can just simply cherry pick. And I can then invest in a tobacco company and I can say, hey, look, Robeco-Sam says that it's a positive ESG firm, therefore I will invest. Is that the right thing to do? One could argue that it is not, one could argue that it is. In fact, this has gotten worse because what has happened is that you have seen that money has flowed into places where one would actually say that they are not completely environmentally sustainable. So for example, after the 2022 start of the Ukraine war in Russia, when gas prices shot up and oil prices, you had a lot of money that flew into Saudi Aramco, which is the largest oil producer in the world. And when investors were quizzed about it, when institutional investors, they said, well, it is that oil company that produces oil at the most efficient way, and therefore it is a good environmental, it's a good environmental firm. That sounds kind of fishy to me. It does not pass the smell test as far as I'm concerned. If I'm saying that you're an environmentally sustainable investor, then maybe you should be investing in solar and wind and maybe not in oil. But here you have like a lot of money that is flowing into Saudi Aramco. And then it became politicized. Back in last year, and actually this year as well, ESG has become increasingly politicized. And this has happened most of all in the United States, where people have attacked environmental, social, and governance practices as being woke capitalism. And as a result, because of this, you have had state governments saying that our pension funds will not flow into those investment firms that are ESG friendly. One of the biggest ESG friendly firms was BlackRock. That's the article on the left over here. And BlackRock has more than $10 trillion of assets under management. And you had different state governments, such as in Florida, Oklahoma, West Virginia, saying, we are not going to invest our pension funds using BlackRock. As a result, Larry Fink, the CEO of BlackRock, reduced the usage of ESG in his annual statements from more than 100 in 2022 to just 2 times in 2023 and 0 times in 2024. And he's saying that, well, ESG has become too politicized. I do not no longer want to do ESG. Now, this is okay, one institutional investor, and so we may ignore him. But it starts to get even more problematic that when you have single TikTok videos that actually derail the entire ESG effort. So earlier this year, a firebrand conservative activist by the name of Robbie Starbuck started making social media posts on TikTok in which he started criticizing firms for having diversity and equity practices in their firms. And he specifically targeted those firms that had a lot of business in traditionally conservative states. And those firms were Ford, Tractor Supply, Caterpillar, Harley Davidson, etc. And in a single TikTok video, he was able to convince the CEOs to actually reverse their uh, DEI programs. And then that then leads me to question, well, if a single video by some firebrand activist is able to, uh, completely derail your social score, then are you really committed to it? I'm asking the CEO over here. Is the CEO then really committed to this, or is this firm really committed to DEI practices? So the point of this thing is, these things that I'm telling you is that, well, ESG is certainly a step in the right direction. There's a lot of work that needs to be done in order to make ESG the most effective way to actually solve the problems that we see in our society. That it cannot be fickle. Remember what Janet said at the start of the thing. We need financial objectives that are aligned with sustainable long-term value creation. Well, if you are able to, on the flip of a TikTok video, able to change your social DEI things, well, that's not long-term value creation as far as I'm concerned. And so we need something more than just ESG, or we need some better regulation that actually allows ESG to actually achieve its full potential. And so there's a lot of work to be done, and that is what I think like Madhu will talk about, and I will stop here. Thank you. Madhu, would you like to take on? Madhu, I think you're on mute.
Great. Can everybody see my slides here? Just give me a thumbs up. Okay. I think Aadhaar has taken a lot of time, so I only have probably 5 minutes. So Janet, just let me know how much time I have. Could you just let me know so that I can make it go?
Yeah, I think 5, 6 minutes,
Okay.
Madhu. I mean, maybe a little more, but I think also
Yeah.
some of the questions I'm seeing are
Sure.
probably going to allow us to talk a little more fully about
Sure.
some of your topics too. So
Excellent. Okay, thank you. So again, thanks for being here. It's your time is very precious. So I'm basically just going to talk a little bit about finance, where finance cuts into the whole thing. So the story is very clear. There is a demand for capital from many players in financial markets, corporates, municipalities, government. There are institutions who are supplying capital, bond markets, equity markets, banks, insurance companies, sovereign wealth funds, pension funds, passive investors, hedge funds, private equity, and whatnot, right? So when there is that demand and supply of capital happening, the suppliers of capital want to hold companies accountable for these metrics, E, S, and G. So, for example, we have Google here, where the S pillar accounts for 45% of its weight. How well it does in the social pillar is really a big part of its ESG scoring. Environmental governance scores equally come at 27%. So basically, this company, which is Google, leads the pack at 4.4 to 4.26 versus the median in that particular industry. Similarly, people who are supplying capital to Shell, an oil company, would look at definitely ESG, but more closely at E pillar, which accounts for 45% of its weight. So the key thing here I wanted to get across, therefore, is that suppliers of capital would also like to see how well this company is doing in these three enumerations, E, S, and G, and in particular E score. And it seems like Shell is coming off at 7.15, far ahead of the rest of the mean, right? So in that particular industry. So basically, therefore, the whole conversations are about, let's say now we just take climate as a pillar, which is perhaps more important to finance industry. A lot of suppliers of capital, therefore, are concerned about how a particular company would be affected by the underlying physical risks, economic losses, therefore, for a company that could arise from the physical risks. And similarly, how a particular company would be affected by assets which could get stranded or outdated because there is changes in technology happening, changes in consumer preferences happening, and the fact that the regulations that are coming and going to take away the bite out of the asset. So therefore, the takeaway is that suppliers of capital would like to put a lens on the company, not ESG broadly, but more so with the E pillar that is evolving as exposures to physical transition and regulatory risks. The thinking, therefore, is that, hey, look, if these climate risks are affecting your company, that's what I'm thinking if I'm supplying capital to a company, that climate risk is going to impinge on the cash flows. So the cash flows are going to reduce, is going to get more volatile. The company is going to be affected by higher operational legal risks. There's going to be higher obsolescence. Put it all together, there is going to be a loss in firm value. So therefore, I'd be extra careful. I will charge them higher spreads. I will extract higher expected returns on the underlying company, right? So many players are there top down. So you got climate coalitions. Aadhaar mentioned UNPRI there. Governments are doing their bit. Regulators are doing their bit. Security regulators, central banks, financial markets, and investor activism. So it is a big bunch of monitoring mechanisms out there. In particular, I'm just going to, since I got only like 2-3 minutes, I'm just going to focus on how financial markets are dealing with this particular phenomenon, right? So just going to show a couple of slides so that, and they'll take more questions and then laid out. So one thought process that has been there in finance is this idea of carbon premium. So basically, the way you think about it is, here are green stocks, companies who are doing better at ESG, and those which are not, the so-called brown stocks. So the idea is that a company who's doing really good in ESG will have a lower risk, and hence investors don't mind paying higher price or accepting a lower yield on the bond, right? And exactly the opposite. If it's a brown risk is a higher risk firm, so I'll only pay a lower price for the stock or expect a higher yield, right? So at the end of the day, therefore, a green stock will require a lower required return, whereas exactly the opposite, a higher risk, higher required rate of return or higher bond spreads for a brown firm, right? So basically, the idea is that the markets, by requiring higher required returns or higher bond spreads, will impose market discipline on such low ESG or brown stock firms, right? And that's exactly what the literature has found. The literature has found that in equity markets, for example, there is evidence of widespread significant rising carbon premium, higher stock returns for companies with higher carbon emissions. And that result is pretty ubiquitous, not just in US and rest of the world. So the way you interpret, therefore, is that investors are already demanding compensation for their exposure to carbon emission risk. So their way of putting discipline on such companies, right? However, with bonds, there's an interesting story that that may not hold. So basically, it seems like the corporate bonds of more brown companies or carbon-intensive firms are actually earning lower returns, contrary to what we find in equity markets. So probably the story there is, look, bonds are underreacting. You don't see that happening in the bonds yet, right? So that is one big headline story. However, that story is actually there in CDS markets. So if you sort of look at the bottom point here, that look, in CDS markets, credit default swap markets, which are like insurance markets for bonds, they charge higher spreads the moment a company has a higher transition risk happening. Okay, so the takeaway is that there is broadly this evidence that stocks have a higher carbon premium. Bonds is sort of mixed, but definitely show so far in CDS markets, right? Then if you look at the loan markets, again, same story in equities, that basically banks charge a higher risk premium for risky borrowers, right? And that story is there. So broadly across the field, so they charge them higher spreads. Whenever there is a negative news coverage about a firm's adverse climate risk, they give them only loans for shorter maturities. They put more covenant tight restrictions and so on. Okay, but broadly, therefore, so that evidence is happening. So the bond lenders are doing their bit. They can do a little bit more. So basically, for example, they're not charging them as much. That's what the literature finds. They're only counting one kind of risk, which is scope 1. They're not counting a broader risk, which is scope 2 and 3. And then they say that, hey, by the way, if you tighten lending to these distressed firms, you have to be careful, because those distressed firms, like oil companies, they can cause more carbon emissions. So you need to be careful, therefore, very relevant to Canada. While lending to banks, you need to be careful what you're charging them. Okay, so I can go on, I think, but we are a little bit tight in time. So I just want to make one slide and stop. One big story here in the equity markets is, look, so I'm presenting the MSCI index, MSCI index, sorry, the ESG versus the ESG leaders versus rest of the US index. So definitely the golden line is outperforming the blue line. So it sort of says that, hey, the ESG leaders are really doing well. And across the spectrum, that's for the last several years, more so in the recent past, after the 2015 Paris Accord. And a lot of those high performers in the ESG are from infotech, healthcare, and communication, and financial staples, consumer staples, right? So if that is happening, so this is my last slide. So therefore, look, there is can that sort of higher returns? What is causing those higher returns? First thing. The second thing is, can we sustain that higher returns, right? So, well, the higher returns are basically coming from the perception, right? Hey, there's a perception that the moment you have a higher ESG sticker, you are going to do well in the sustainability space, so your overall risk is low. So there is that reason, perception. The other is the demand, right? The attention to climate news and hedging climate risk. So so as a result, investors are pouring money into these ESG friendly companies. Yes, they are demanding a lot. So the more you demand of such stocks and bonds, their prices go up, right? So perception, prices go up, demand, prices go up. And values, so because perception, the mission value or the true appreciation, I believe in ESG, therefore I don't mind paying a higher price, right? So there's a higher demand or higher perception, higher values, which is driving this greenium or carbon premium, right? But there's no guarantee that this is going to sustain. That's what the literature says. Because the investors' demand for green assets. So basically what's happening is there's a tilt towards green demand away from the brown demand. How so? Investors are pouring money into green assets. We've seen that in the previous slide. But there's also consumer demand for green products. That's also pushing up the prices, right? So therefore, overall, there is a tilt towards green companies, green products, which is therefore pushing the green. And exactly the opposite reason, the brown companies are being pushed down, right? So this is that wedge that is creating this abnormal returns for green stocks. That's what the literature says. And this performance, therefore, is unexpectedly strong, increases in environmental concerns, not high expected returns. So what it says is, it's not like these green companies are really doing better than other companies. It's just that there is so much concern in the markets which is why these stocks are doing well. So there is no guarantee that the past performance, the fact that these companies are doing well, is going to continue, because the focus is not that these companies are really doing better. It's just that there's more concern. Okay, so I'm going to basically therefore say that we have a lot of research in our own school happening around various themes, and those themes would be the role of carbon risk management, how that gets filtered out, or the role of short selling in this climate risk, or the role of technology affinity as to how companies link to each other through backend technologies, how they are getting evaluated in this climate space. And finally, how is the overall institutional ownership shaping the climate risk discussion? So there is a lot of stuff that is happening at Laurier in this space. And I think just to summarize, there's the key monitoring mechanisms as far as institutions who are supplying capital are all robust. And I just took a few minutes to show how financial markets are doing this. I think there is a lot of interesting stuff that's going to happen. Everybody is learning through this, including researchers. Thank you.
That was great, Madhu. And I know you have so much more to say. I was lucky enough to take an ESG finance class with Madhu last semester, and it was excellent. So I know that there's a lot more that both he and Aadhaar could talk about today. But unfortunately, I think it's time to switch over to maybe some of the questions that we've received. I think this is a good one, because this first question is a good one, because I think it kind of gets at taking all of the high level discussion we've had and bringing it right down to the individual level. And the question we have is, how can individuals support sustainable finance initiatives? And maybe Madhu, maybe we'll start with you, and then we can see if the rest of us have some thoughts too.
How can individuals, so you mean how can individuals make greener choices? Is that the question?
Yeah, it says, how can individuals support sustainable finance initiatives?
I think it's really about their mission. There's no right or wrong about it. So if you believe in ESG, then buy green products and buy green companies, and be part of this ESG discussion that's happening. So you can be both supplier of capital as well as demander for such products.
That's great. That's great. Aadhaar, do you have anything to add to that?
So one thing that we say that if you do not engage with your firm, then you will not be able to then make a difference. So I would say that if a person is really committed about some either environmental or social practice, then they should actually engage with the management of the firm in, say, annual general meetings that happen online, and address the concerns with the firm management, that they should actually choose those projects that are either environmentally sustainable or socially responsible. So that would be my thing.
Yeah.
Unless you do not engage, they will not listen. So I think shareholder democracy is the term that is used in finance. That would be the most easy way to do it.
No, that's great. And I'll just add, I think, as a retail investor myself, thinking about asking questions of investment advisors, investment managers, and trying to push to understand how they are looking at some of the data, how they're interpreting some of the ESG information that's available for equities. I think that's also kind of another way that individual investors can have a role in this conversation. Great. And we've got another question in the hopper here. Do you believe that implementing policy regulations is the most effective approach to standardize and regulate ESG reporting and metrics, similar to how accounting practices are governed? And actually, I think, Aadhaar, you probably have the best perspective on this, but maybe we'll start with you. So maybe we'll start with you.
Sure. So yes, there are actually frameworks and disclosure projects that are actually well underway, that are actually trying to standardize the way ESG disclosures are made, that can actually help investors to do it. So I'll just take two examples. So for example, there's one called GFP, Global Financial something, I forget the name. And then you have SASB, the Sustainability Accounting Standards Board. And they are actually making regulations. They're still in the guideline phase. They have still to be adopted. And these will be voluntary disclosures that firms will be making, that will then inform the investment community about how environmentally and socially responsible their products are. So that is, so it's a work in progress. We are
Yeah.
still.
I guess, yeah, I've been following what's happening in the EU in that regard, where I think they are out ahead of the rest of the world in terms of requiring corporate disclosures of ESG metrics. And I think it's still probably a limited set of disclosure metrics. But my understanding is they're taking an accounting approach to how that data is being generated and then reported.
Yes.
Yeah. Okay, we've got another question. What reliable sources of information or online platforms can we look to for ESG related information? And maybe Madhu, we'll start with you, and then maybe the rest of us have some thoughts here too.
Retail investors, I would say Bloomberg right away, but retail investors would have difficulty. So MSCI, for example, maintains some databases, so you can go and check it's online. But Bloomberg is the best source. If you don't have access to Bloomberg, check out MSCI and data providers. So I think even sustainability, Sustainalytics of Morningstar may have some data, but that's all I have to add there. Yeah.
Yeah.
Yeah,
Aadhaar?
just piggyback on what just Madhu said. So Morningstar is another thing. They rate their mutual funds based on, they call them globe ratings, and they are rated from 1 to 5, 1 being the worst, 5 being the best. So investors who want to get this information, like they can go to either Morningstar, MSCI, Sustainalytics, and they can see these reports. It can get complicated though. So just.
Well, and I would say I'm seeing that the even the information that is self-reported, voluntarily reported, I think there's been an improvement in the information or the quality of the information that's getting reported by corporates as they are, as the EU and other jurisdictions are pushing them to use accounting practices as they're considering their ESG data. So I hope that as we move forward, there will be more reliable information readily available to the retail investors, even through that angle. All right, next question. And I'm just watching the time. Okay, good. I think we probably have time for a couple of more. I know we're whipping through these. But the next one is, this was touched on somewhat, but how is the market assessing the risk of climate change? And I think, Madhu, you started down that road, so maybe if you wanted to add a little more there.
Yeah, correct. So basically, I think the stock markets and the more active CDS markets, credit default swap markets, are assessing this. I think so basically that's a short answer to your question. The loan markets are assessing this well. The problem is also about how to measure this. So that's why there's a bit of fuzziness. So how do you measure this, right? So if you look at carbon emissions per se, that data is a very low frequency number. You only have it an annual number, right? Probably quarterly, right? So that number doesn't move that fast. So therefore, if you simply take a data such as CDS spreads and try to correlate it with carbon emissions, you may or may not see the result. So therefore, what profession is doing is leaning on developing some more textual analytics measures, right, based on the earnings calls these analysts do on a quarterly basis, and use that to see and extract more forward-looking measures. So what I'm getting at is two-part answer to your question. Yes, markets are reacting well. The second point is the problem is not in the markets, but in the measurement of this. The carbon emission, it's a slow-moving number. Therefore, what is more sensitive is this forward-looking variable that you can get out of the textual analytics. And profession is really very successful in producing such forward-looking measures.
Yeah, that's great. That's really great. Thank you for that additional explanation. Aadhaar, did you have something to add there?
Yes, actually, markets are reacting to this. So yeah, I'll echo just what Madhu just said. But they are actually reacting. They are actually reacting in places where we typically do not actually look for. So, for example, municipal bonds for those municipalities that are actually closer to the sea have actually gone up. So, for example, the cost of borrowing for schools, for building schools in Florida is now much more higher because Florida is now actually exposed to higher sea level rise. And since bonds are laid out for, say, 30 years, 40 years, for long periods of time, investors do actually take into account, well, if this is the level of sea level rise that I can expect 30 years in the future, I will actually charge you a higher interest rate for this risk that 30 years from now, the school may be underwater, literally.
Yeah.
So yes, there
That's
is a
an
reaction that is
interesting
happening there.
observation too. Yeah.
Yeah.
All right, we've got time for one more question. I'm not sure how in depth we're going to be able to answer this one, but I think it's a good one and important. So many developing countries, and I'm actually going to say also corporates, do not have access to the capital to fund the environmental aspects of their organizations' metrics and targets, because it would be too costly to implement them. And there is not often a regulatory driver in some of these operating environments. So how would investors look at some of these areas to address these concerns? Is there a role for sustainable finance in these conversations to try and support projects that are going to be necessary for these, countries, organizations, and institutions?
I'll take that, Janet. So I think so. There's two-part answer. So I think it's the sovereigns who are borrowing, and secondly, role for private equity, right? So I think sovereigns are also borrowing in this space. So sustainability bonds, green bonds. So if there is a lack of market, particular segment, governments can step in, right, and take that role, and so there is a global market for these sovereign bonds, green bonds. So that is one way to fix it. Second, so therefore the government, you expect, should therefore be responsibly involved in this. If not, if it is not a public firm, it is a private. If it is a private firm, the question alluded to, for example, right? So there is no access to public capital. There's a role for private equity. I think private equity is seeking out many such agents of change, and if there is a way they can access the private capital, I think there's a lot of room for it. I know India and China are really far ahead in this game. So my answer is therefore is government sovereigns and the private equity if it is possible. Yeah.
Great. And I'm just going to add to that because I'm seeing that in my own professional life where there is more activity from private equity than I ever expected in this field. And it's been kind of an interesting shift. I think there are also a lot of other institutional investors who are looking at these kinds of projects and trying to understand if there is a strong enough ROI to get involved. So yeah, exciting times, I think, because the way that we are funding these projects is changing. And with that, actually, I'm going to have to wrap up. So that's all the time we have. So thank you to everybody who submitted questions. And I'm sorry that we didn't get to all of the questions. I think